Have you ever looked at a pro trader screen and wondered what separates them from everyone else? Well, I can tell you it's not a crystal ball and it's definitely not magic. It's all about mastering a very specific set of tools. So let's open up this toolkit and see exactly how the pros build their edge piece by piece.
And that quote really hits the nail on the head. You see, the goal isn't just to watch the charts. It's to analyze them, to read them with a real framework. These tools are what take you from pure guesswork to a repeatable, strategic approach.
So, what is the big secret? Well, it's not some single magic indicator. Nope, it's a methodical process. It's about building a case for every single trade you make. And that process, well, it starts with the absolute bedrock of all technical analysis.
Right here. This is where it all begins. Before you even think about fancy indicators, a professional first maps out the key battlegrounds on a chart. We're talking about the specific price levels where buyers and sellers have historically gone to war.
And honestly, the best analogy is just this simple. Support is the floor that the price just has a really hard time falling through. And resistance, that's the ceiling it keeps bumping its head on. The more times the price hits that floor or ceiling and bounces off, the stronger and more important that level becomes. But how do you know if these levels are actually real? Well, pros have a simple rule for this. They don't just draw lines all over the place. 2 touches on a chart? Okay, that's an idea, a potential level. But that third touch, that's validation. That tells you that big money, the institutions, are actively defending that price. And if you get 4 or more touches, now you're looking at a major level that pretty much everyone has their eyes on. And here's the thing. These floors and ceilings, they're not always perfectly flat. For markets that are just kind of chopping around sideways, pros use these horizontal or static levels. But for a market that's clearly on a mission, trending up or trending down, they switch to slanting or dynamic levels, like trend lines, to map out the flow.
You know, one of the biggest keys is to avoid clutter. A pro chart is clean. It focuses only on the 3 or 4 times most significant, most recently tested levels. Here's a great tip. If you have to squint and really force a line to fit the price action, it's probably not a real level. The market should make them obvious to you. Okay, so once that basic map is drawn, the pros start adding layers. This is where we shift from the art of drawing lines to the science of objective, calculated levels that institutions rely on for their entries and exits.
And that brings us to a fascinating tool called Fibonacci retracement. It basically just measures how much a price has pulled back after making a big move. The first key level everyone watches is 38.2%. A pullback to here is often just considered a healthy little breather in a strong trend. It's the first real test to see if the buyers are still serious.
Next up is the 50% level. Now, funny enough, it's not technically a real Fibonacci number, but it is a massive psychological benchmark. Just think of it as the give back half the gains point. If a stock can bounce hard from there, it's a powerful sign that buyers are still in control, even after a pretty deep dip.
And finally, you have the famous golden ratio, 61.8%. The pros often see this as the absolute last line of defense for a trend. A strong bounce from here can be a fantastic opportunity. But if the price breaks down through this level, it's a huge warning sign that the entire trend might be in jeopardy. Pros also use something called pivot points. These are just mathematical levels that are calculated every morning based on the prior day's price action. But what's really cool is how pros adapt their strategy. As you can see, if the market's in a strong trend, they're looking to trade breakouts through those first levels. But if the market is just chopping sideways, they do the opposite. They play for bounces off those same levels, where the odds of success can be even higher.
So we've got our static map and we've got our calculated levels. Now it's time to add a dynamic layer. We need tools that actually move with the price, tools that can tell us about the trend's health and momentum in real time.
And this is where moving averages come into play. I want you to think of them as smart, adaptive trend lines. In a healthy uptrend, a key moving average, like the 50-day, will act like a rising floor that follows the price up, giving you these clear, beautiful little spots to potentially buy on the dips.
Now, when you put 2 of these moving averages together, a fast one and a slow one, you can get one of the most powerful long-term signals in the entire professional toolkit. It's called the golden cross. That's when the faster 50-day crosses above the slower 200-day, and it often signals the start of a major new bull market. And its evil twin? The death cross, which is a critical warning that the long-term trend might be turning down. Okay, we've looked at a bunch of individual tools now, but here it is, the real secret sauce. The pro move that ties everything together is finding where these different tools all line up and agree. This is the concept of confluence.
This, right here, is the absolute essence of professional analysis. It's like you're an investigator, and you have multiple, independent witnesses all telling you the exact same story. When a horizontal support line, a 61.8% Fibonacci level, and a rising moving average are all pointing to the exact same price zone, well, that's what you call a high-probability setup.
So what does this look like in practice? It's literally a checklist. For a long setup, a pro asks, is the price in a clear uptrend above its moving average? Check. Is it bouncing off a support zone that also lines up with a key Fibonacci level? Check. Are momentum indicators like the MACD and RSI confirming the move has energy behind it? Check. And the big one, is trading volume picking up, showing that big institutions are buying? Check. And for a short position, it's the exact same logic, just completely inverted. You're just waiting for the weight of the evidence to stack up on your side. You want price in a downtrend, hitting a confluence of resistance, with momentum fading and selling volume confirming the move. It's all about systematically stacking the odds in your favor. And that's really the entire journey. We've gone from looking at a blank, maybe even intimidating chart, to building a strategic map that's filled with objective, actionable zones, all based on tools the pros use every single day. And this really brings us to the single most important takeaway of all this. Please remember this. None of these tools are perfect. Not one of them offers certainty. The entire goal of professional technical analysis is to stop looking for certainty and instead to focus on systematically increasing the probability of being right.
Which kind of leaves us with one final thought. Ask yourself this: are the pros really trying to predict the future? Or are they just world-class risk managers who are patiently waiting for those moments when all the evidence aligns to give them the best possible odds? It's a fundamental shift in mindset, and it's what this is all about.